The year 1980, two brothers tried to single-handedly take over the world's silver market. They had billions of dollars in their wallets. Their goal was simple: lock up silver and send its price sky high. And for a while, they succeeded. The price of silver per ounce increased six-fold in just a few months. Then, everything collapsed. They wiped out half the market value in a single day. Now I ask you, what would have happened if you had gold that day? Or silver? This video isn't just answering the question, which is more valuable. It will show you with real numbers how crises, wars, inflation, and panic moments throughout history have distinguished these two metals from each other, which one is truly a safe haven, and which one is a high-risk gamble. Watch until the end, because the event I'll tell you about in the third example directly concerns the money in your pocket today. Gold and silver are humanity's oldest symbols of trust. Pharaohs identified gold with gods. Romans distributed silver as wages to the army. But in the modern age, especially during crisis moments, these two metals display very different characters. Gold, calm, steady. The harbor people run to in panic mode. Silver, exciting, volatile, a metal chased by both industry and investors, but sometimes one that burns its owner too. In this video, we'll examine three major crisis periods under a microscope: the stagflation monster of the 1970s, the 2008 global financial crisis, and the 2020 pandemic shock. In each one, we saw how gold and silver behaved, which investors won, and which ones went under. If you're ready, let's begin. To understand gold's role in crises, let's go to the 1970s. When the U.S. collapsed the Bretton Woods system and disconnected the dollar from gold, the world literally lost its fixed value guarantee. In the same period, the oil crisis exploded. Inflation soared to double-digit figures. The result? Gold, which was $35 per ounce in 1971, climbed to $850 by 1980. This means approximately a 24-fold increase. When people lost faith in their dollars, they ran to gold. Because gold cannot be produced, cannot be printed, no central bank can say, "Let's print a bit more gold." Now let's jump to 2008. Lehman Brothers collapsed. Banks stopped trusting each other. Stock markets bled. While the S&P 500 index lost 38% value, gold rose around 5% in the same period. It might not seem like a significant difference, but remember, in an environment where everyone was selling everything, gold staying positive proves its role as crisis insurance. But why? Because gold's value isn't tied to a company's profit or a government's promise. It's tangible, physical, with limited supply. Even central banks increase gold purchases during crises. In the post-2008 period, world central banks became net gold buyers for the first time in years. Now let's come to silver. Silver has a much more complex character than gold. Because more than half of silver's demand comes from industry, electronics, solar panels, medical devices, even the circuit boards in your cell phone. This makes silver half precious metal, half industrial raw material. And this dual identity makes silver both an opportunity and a trap during crises. Let's return to the Hunt brothers example you remember. Between 1979 and 1980, Nelson and William Hunt began physically buying up a large portion of the silver market. Silver jumped from $6 to $50 per ounce. That's about an 8-fold increase. But when exchange rules were changed and margin requirements were increased, the brothers couldn't maintain their positions. On what's called Silver Thursday, the price collapsed 50% in one day. The Hunt brothers came to the brink of bankruptcy. This shows us silver responds much more to speculative movements than gold. Because the market is smaller, big players can easily manipulate the price. Now let's look at the 2008 crisis. While gold was rising, what did silver do? Initially, it also fell. Because industrial demand collapsed, factories closed. Silver lost over 25% value, right during the period when gold was rising. So during the crisis moment, silver didn't behave like gold. It behaved more like an industrial metal. This is where the gold-silver ratio comes into play. This ratio simply shows how many ounces of silver are needed to buy 1 ounce of gold. In normal times, this ratio usually fluctuates between 50-70. But at the beginning of the 2020 pandemic, when panic was at its peak, this ratio rose to an unprecedented level in history, above 125. So 1 ounce of gold became equivalent to 125 ounces of silver. What does this mean? While everyone was running to gold during panic moments, silver was left behind as industrial demand collapsed. But here's where the really interesting part begins. When the economy started to recover, silver rose much faster than gold. Towards the end of 2020, the silver price increased over 140% from its bottom point, while gold showed a much more modest rise in the same period. So silver suffers more than gold at the deepest moment of crisis, but leaves gold behind when recovery begins. That's why some investors define silver as high beta gold. It moves in the same direction, but much more sharply. Now let's put these three crises side by side. 1970s stagflation, gold won, by far. It became a real shield against inflation. 2008 financial crisis, gold positive, silver negative. During crisis moments, gold truly played the shelter role. 2020 pandemic, both fell in the initial shock, but silver fell harder. In the recovery, silver won by far. The conclusion from this is clear. Gold is the most reliable shelter for the initial panic of crisis. Low volatility, high liquidity, and most importantly, supported by central banks. Silver works like a leveraged bet. It can cause pain when the crisis deepens, but can offer much higher returns when recovery signals come. Moreover, industrial demand, especially growth in the solar energy and electric vehicle sectors, adds a different, long-term demand source to silver that's different from gold. So the question isn't actually which is better, but what risk do you want to take? If you want to protect your capital and sleep well, gold. If you can tolerate volatility for higher returns, silver. History clearly shows us that during crisis times, gold and silver don't play on the same team. While gold gives you the confidence that at least I won't sink during tough days, silver tells you either you win big or you lose big. So what should you do? Most professional investor strategy is actually to use both together, viewing gold like an insurance policy and silver like a turbo that increases potential returns. But remember, no metal, no investment instrument is guaranteed. People who put everything into silver in 1980 lost their fortunes overnight. Those who only trusted gold in 2008 got through the crisis relatively calmly. Which do you think should be in your portfolio, calm and steady gold or bold and volatile silver? Share your prediction in the comments. Tell us which crisis surprised you the most. If you like this video, don't forget to like and subscribe to the channel. See you soon.